Hello, I'm Robbie Thompson with the Credit Union Association of the Dakotas, standing here in the border of North and South Dakota. This is a high agricultural area with lots of farming and agricultural communities. And that's where many of our credit unions are located, small, rural, agriculturally centered communities. And these credit unions are very concerned about the risk-based capital rule proposed by NCUA. They're concerned that it's going to hinder their ability to provide mortgages, small business loans, and most importantly, agricultural loans to farmers and people in these communities that need and rely upon the credit unions. So we've taken the opportunity to come out and have a conversation with many of our credit unions in these areas here in rural South Dakota and rural North Dakota. We hope that NCUA considers this as they look at their final rule. We hope that they take into consideration the risk weightings and look at ways to help these credit unions be able to continue to lend. Without these credit unions in these communities, many of these farmers in rural areas would be subject to higher interest rates and higher fees and less competition. And we're very concerned with the overall impact that this rule is going to have on these credit unions in these areas. So let's hear from some of our credit unions in North and South Dakota and learn a little bit about what the impact that this risk-based capital rule could have on credit unions in rural North and South Dakota.
Dakota Plains Credit Union has been here for 73 years. We are based on consumer and ag lending. Back in '85, the credit union expanded into the Ellendale community, and not less than 5 years ago, we expanded into the Enderlin community in North Dakota. We're all about the same in the community size. We're anywhere from 650 up to probably 900 people in the community. All these communities are very much ag-based.
Dakota Plains Federal Credit Union emerged in 1957. We are an ag-based credit union. About 50% of what we do is ag-related, ag and commercial. Lemon was originally established as an ag community. The town is named after George E. Lemon, the founder of the community, and he was, at the time, he had the largest amount of cattle acreage within fences in the world at the time.
North Star Community Credit Union was established in 1940 by the local farmers and businessmen of the small community of Maddock, North Dakota. They were chartered for the purpose of offering financial services to the local co-op members, which was the Farmers Union Oil. We currently serve 5 areas: Rugby, Maddock, Bottineau, Grafton, and Cavalier. And we are an ag lead lender in all of these communities.
Hometown Credit Union originated in Calm, North Dakota in 1949. So we're in our 65th year of operation. We serve primarily farmers and ranchers. Right now we have about 3,000 members and about 87 million in assets. A majority of which are put out in ag loans to help farmers and ranchers buy equipment, livestock, put in their crops, and buy real estate.
Dakota Land is a rural credit union in eastern South Dakota that serves about 28,000 members. We have 9 branch locations, with Huron having 2 offices. Also includes Brookings, Madison, Volga, DeSmet, Redfield, Woonsocket, and Mitchell. Actually, I have 25 counties and encompasses 19,440 square miles, or 197,000 people, or 10 people per square mile.
First Community Credit Union, we were founded 75 years ago right here in Jamestown, North Dakota, by a group of farmers. And we have since grown to 15 branches in 12 different communities and close to 500 million in total assets right now, with 400 million in loans. Smaller communities like Wishick, Napoleon, Steele, and Milner, those are all communities that have like 800 or less people. In many cases, there's just us and one other financial institution in the entire town.
Agricultural lending makes up 50% of our portfolio. And that is between agriculture, capital loans, operating loans, and a lot of that is also ag real estate loans, which are very good loans.
We help our ag industry, and we help our small business along with our consumer base. We are just short of $50 million right now. We're about $47.5 million. And, you know, we're looking to grow. That's part of it. If you don't grow, eventually overwhelmed by the competition.
We currently have 48% of our portfolio in ag lending, which consists of real estate, operating, equipment loans, and storage grain loans.
Our agricultural loans make up roughly 80% of our loan portfolio, and our loan portfolio is about 90% of our assets. So you could say that about 70% of our assets are invested directly in agricultural loans.
Mortgage lending comprises of about 40% of our total business, and business lending is about 20 to 25% of our total business. And we serve a lot of the low income and a lot of the moderate income folks. That our average mortgage loan is about $61,000 is the size of it. So it's very small. And you know, we do a lot of small business loans, and a lot of people that don't have, that the banks really don't want to serve.
Ag is our bread and butter, so to speak. Out of the $400 million in total loans I mentioned earlier, $160 million are lent directly to farmers for production ag. Then, you know, with the makeup of North Dakota's population, I would say roughly 60% of our loans, maybe 70%, have some kind of an ag influence in them, like maybe a supplier or somebody who's supporting agriculture in another way.
Really concerned about the methodology in which they come up with it, and that being the 200% on the assessment after the greater than, if you would, in the business lending side of it. That is going to have a detrimental impact on Dakota Plains Credit Union. We are a credit union of 60 million. We've grown 16 million in the past 2.5 years simply because there was a need for us here. And that will have a huge impact on us moving forward, simply because the amount of capital that we're going to have to create in the same method that we've done over the past 73 years. That's a huge, huge hurdle for us to get over.
My concern is right where we were at year end, December 31st in 2013. We would pass both tests, but under the new rules, we would pass the secondary capital, the secondary risk-based capital, by 0.1%. That's a damn slim margin to feel comfortable about operating and being able to make the decisions we have to make. My concern is, do we in fact say, hey, let's hold back this growth and not get to $50 million? You know, that's certainly a business decision, but that has all kinds of implications to it as well. And are we serving our members by doing that?
My concerns on this proposed rule is the ag lenders that we already service. We would have to pick and choose then going forward of who we're going to do an ag loan for and who we're not going to do an ag loan. 74 years of business is what we've done in ag lending. So how do we say now when they walk in the door, well, I'm sorry, we can't help you anymore. You'll have to go to the bank next door or the farm credit services that are mainly our competition. So it will be a huge impact on us. Look around, it's what we do, and it's what we've been good at doing and done low risk lending in the past.
Well, the primary concern is the higher risk weighting it's going to put on us for our member business loans, which in our case is all our agricultural loans. Calculations that we've done indicate that we would need an additional $3 million in capital at this point on top of the almost $10 million in capital we currently hold. The rest of that concern is that to fund future growth, and we have grown over the last 10 years about $60 million, or an average of $6 million a year. If that trend continues, we would grow $30 million in the next 5 years, roughly $4.5 million of capital to fund that growth, plus the $3 million to meet the new regulations. That's $7.5 million of capital in the next 5 years. That would take every penny of our expected earnings for the next 5 years just to fund growth. There would be no funds left over to improve our facilities, to add extra new technologies for our members, to service the needs of our communities.
I think the biggest challenge is really the fact that, you know, as we would maybe grow, we might have to start slowing our growth down in the lending areas And it could reach the point where we're having to curb mortgage lending or business lending, and which means we're going to start turning down loans for people that really need them, and especially the loans that are somewhat marginal and where they really don't have the option to get the loan anywhere else. And we would have to start potentially curbing that.
We have a number of concerns with it, but as you asked, the primary one is the weighting of business loans. Under the proposed rule, MBLs are weighted, anything over 15% of your asset size is weighted at 150%. So basically you got to count, if you do $1 million loan, you got to count it as $1.5 million. And anything over 25% is weighted at 200%. And then they lump all the MBLs into one bucket and call it a concentration. And for our credit union, we're roughly in 60,000 square miles from the Red River Valley in the east out into the rolling hills west of Bismarck. And our loans are geographically diverse. Many different types of business loans we do. Again, generally 160 million are ag, but we also have 80 to 90 million dollars in small businesses, multifamily homes. Even within agriculture, we have ag real estate, we have equipment, we have barley loan, barley and wheat out west. We have soybeans and corn in the east, cattle, very wide-ranging types of loans. And then for the risk-based capital proposal, says they're all one loan, basically, one type of loan. And so they really hammer us on that. And that's simply not accurate.
To put it in a short way, we this year had a father and a son come to us and asked if they could come on board. They had some issues at their prior lender, and the son wanted to get in. We had ways with working with our state bank on some programs, and we were able to put together a lending package for them so we could bring those on board. With this new risk-based capital rule, we do not have that opportunity.
It would have a severe impact. We don't deal with the very large ag lenders. I mean, those guys, they have other means available to them. We deal with the average guy. We deal with the middle market guy. There is not a ready market for them to go to. We take a look at what they do and we work with them. We try to improve their operation over time. So yeah, the guy that's the big cattle guy, he's got wherewithal to go places. He's got options that are available to him. The guys we deal with, a lot of times, they don't.
They'll have less choices of who they can do their business with. If we have to limit the people who come in our credit union and do our ag lending, then we are sending them off to the competition, and which we don't feel is the better resource for them.
The whole base of all our small town communities is agriculture. And if we're not financing the farmers and ranchers and giving them what they need for their operations, it's going to have a huge impact in the community. I can take communities that don't have active financing for the ag lenders or agricultural financing, either with a bank or a credit union, and they suffer. You can see it in the size of the town, the size of the main street. It's hugely important that we fund our producers and keep them viable.
Would create almost a little bit of a credit crunch because certain folks would not be able to get financing anywhere else. A lot of times we do loans in-house because we know them and we understand, and those folks probably wouldn't have options anywhere else.
Our members would be hurt because, as I mentioned earlier, a lot of these communities we're in have only one other financial institution. If we're currently pulling out of the business, the ag lending, they're going to have to go to the one institution in town. The one place where we really started doing business loans, we were able to get some of the loans away from the local bank because we were priced 2% cheaper. 2% on $1 million loan is $20,000 a year. Now, if we are out of that equation, that same loan now probably goes back up 2%. And farmers, small businesses, they're borrowing. It takes a lot of money to operate in today's environment. So you literally could be talking a lot of money that the consumers are going to have to pay, and then also reduction in services.
Credit unions in North and South Dakota are safe, sound, secure financial institutions. They didn't take part in the risky lending that caused the financial crisis. They've been lending in agricultural communities and rural communities for 75 years. These communities rely upon credit unions for their lending. They give mortgages in these communities. They give small business loans that help out these small communities. And they want to continue to do so. So I hope we've given you an opportunity to understand what life is like in North and South Dakota and to hear some of the concerns that our rural and agricultural-based credit unions have with the NCUA risk-based capital proposal. We hope that you take that into consideration as you're writing a final rule. We hope that you think about how this would impact these good, strong communities that are the lifeblood of rural America. Thank you.